Welcome everybody for this webinar session today. It's the third of its kind of our COVID-19 briefings for Nordic startups and scale-ups. My name is Kent, and I'm heading Danske Bank Growth in Danske Bank, where we are a specialized unit focusing on startups and scale-ups. It is in many ways a special situation we are in. We are in a global health crisis, which now also reflects into the financial environments, and especially also into the startup ecosystems in the Nordic. So it's really uncertain times, and we try to get an overview of where do we see the biggest effects. And you have been really helpful on helping us gaining these insights. So right now we have done a survey where more than 500 startups has been so kind to help us get these insights. And what we can see so far is definitely that the crisis has a huge effect on new startups out there. 81% are worried for their sales, and 54% are actually saying that this crisis will have a negative effect on their planned funding rounds or upcoming funding rounds, which is what we will try to deep dive on a little bit more today. So based on this survey, we have tried to create this webinar series where the goal is to put some of the timely topics on the agenda, and the focus will be on you guys being able to ask the questions that you have, and we will try to answer them as best as possible. So that is where we will use 75% of our time today. We are super excited for so many people joining in today. We should be plus 100 people attending this webinar, and I'm rather sure that it's because of a very special guest that we have, and also the very relevant topic related to the situation that we are in. I have Tommy Andersen from managing partner from ByFounders joining me in, and a successful founder himself. But Tommy, welcome to the session here today.
Thank you very much.
Could you just shortly introduce yourself a little bit?
Sure, I can. So my name is Tommy Andersen. I'm one of the managing partners of a fairly new venture fund here in the Nordics called ByFounders. And maybe I should start with a disclaimer. So the views that I'm going to express today are going to be mine, and it's going to be the ones of ByFounders, of course. I cannot speak for the entire venture industry. I cannot speak for every investor. So it's going to be the view that we have sitting here in Copenhagen and making investments throughout the Nordics and Baltics. My own background has been, I've been in corporate for like roughly 10 years. And then I've been a founder myself for just below 20 years. Started my first company in the midst of the dot-com crash in 2000, 2001. And so I've lived through quite a few recessions myself, also the latest financial crisis with my company. So I think I at least have an understanding and a view on how to weather a recession and how to prepare for a recession, which is what I think we're standing in front of right now. So currently I'm one of the partners of the fund, and we are 2 years into our fund cycle. So we've been active for 2 years. I'm going to reflect a bit on how that, also influences, how we invest and how we see the world right now.
Thank you a lot, Tommy, and we are so happy for you joining in today. The topic of today is how the Nordic-based VC thinks and acts in these special times. Just a few practical things. So questions, please share them on the chat. So already now, think about what kind of questions would you like us to talk about, and post them on the chat. Then I will try to manage to coordinate everything and ask the questions as we go on to Tommy. Tommy will start out setting the scene, so he has 2-3 slides just setting the scene related to the agenda, and then we will move down to the Q&A session.
Yes.
So please already now share your questions on the chat, and then I'll give the word to you, Tommy.
So let me start by that. So ByFounders is what we call a four founders ByFounders fund. and we're dedicated to Nordic and Baltic startups with global ambitions, meaning that we have a geographical mandate by our investors to invest in a specific geographical area. We can also invest outside the Nordics and Baltics if we have Nordic or Baltic founders. And we've done that actually. We've invested in 4 companies in Berlin. We have invested in a handful of US companies. But mostly we try to invest our money here locally in this geographical area. And that, of course, also implies then, what I'm talking about here is mostly going to be new investments in this geographical area we're sitting in right now. Next slide, Miguel. So just a bit about where do we sit in the market. So I've tried here to visualize, the different phases that we see for investments. And to the left, you see where would we like to lead investments. So we take the majority of a given round, and where we would like to be a follower. And if you see at the pre-seed stage, which is basically what we would call a concept phase for any company, where you have a vague idea of your market, you may have a vague idea of your customers, you have some kind of product, you don't really have a product market fit yet, and everything is quite new. Typically, the team is below 10 people, and you basically need money to get off the ramp. In those investments, we will typically not lead. You will see an angel leading those funds, or a group of angels, or you will see a pre-seed fund leading those deals. So in Denmark, that would potentially mean people from Danban or other angels syndicates, or you would see funds like pre-seed ventures or others do those kind of investments. We will happily be a follower in those deals, meaning we will throw in a smaller ticket to participate in the round, to get early eyes on the company, and basically just to follow the company and see how it evolves. And those tickets in that area are roughly 250k euros. Where we would like to lead is at the seed phase. So seed phase is where you have a product, you have a good understanding of your market, you have early traction on users, may even have some revenue, and you are getting close to the product market fit, i.e. you have a product or service or an offering that fits a group of customers, and you can see that is working and you can start to scale the company. In those investments, we'd like to lead. So we take the lead in those rounds, we fork down the majority of the money there. And what used to be the leaders, the angels and the pre-seed funds, then step down to be followers. In that range, we typically invest 1 to 2 million euros. After the seed phase, you come to a growth phase. Series A is where companies they are very certain about their market. They have an extensive user or client base. They have revenues and they have a strong growth. In those investments, we can lead, but we typically would co-lead, meaning that we would probably be in a position where we take the run with someone else. And that would typically be an international venture fund, because Series A companies are on the verge of going international, may even be on their way to doing that. And then there's Series B plus, as we call it, Series B, C, D out there. We only have a minor role there as a follower. We will do pro rata, as I said at the bottom, meaning we defend our ownership, but we don't really have an active role to play. So it's important when we discuss the next slide here to see we're a seed fund and where we're then based. So I've tried to put out 4 areas to discuss here, and I'll run around the wheel and talk about those. And also, feel free to post questions around these areas or others that you see. So the current status, this is April 2nd, 2020. What has happened? So we, as a fund, we went to our home offices roughly 4 weeks ago, and I've been there ever since. And we're probably going to be here at least a month now, I guess. I don't think the after Easter opening is going to happen. So we're probably going to be here another month. So what happens if it becomes dire times? You take care of your family, as I write in the first bullet there. And the family in our case is the current portfolio. As I said in the beginning, we are roughly 2 years into our active fund cycle, and the fund cycle is 4 years, meaning that we have currently 24 investments. So what we did immediately was to query them all and say, hey guys, how are you affected by this? How do you see the current environment? How do you expect to be hit by, first of all, COVID-19, and how do you expect to be hit by a recession? And then we put priorities on all these. So the RIG means red, yellow, and green. So all the companies that had more than 12 months runway, i.e. 12 months cash in the bank to operate, are by definition in green, because they're not urgently in need of funding. So those are in green in our terminology. The ones that are yellow are the ones that have runway between 6 and 12 months, i.e. they need to fundraise sometime in the second half of this year, or maybe early 21. And the ones in red are the ones that only have between 0 and 6 months runway, i.e. they're either fundraising right now or very close to fundraising. And we've shifted our priority to helping those companies now, because they have really significant troubles in fundraising in the current environment. We also asked all the companies to look both at the short and the midterm effects of what we're looking at. And it says in the center of my slide here that it's a COVID-19 effects, but you could almost change that to being recession effects, because I think once this COVID-19 thing starts to mature in the way that it runs around society, this is going to be a deep recession instead, because all the side effects of the COVID-19 are now turning into a full-blown recession instead. I think the only thing that we're not sure about is for how long and how deep. It also means that, as I say to the left again, that all normal budgets are off. At the current environment, the budget that you put down in early 20 or late 19 for 2020 calendar year are just going to be off, because all of the effects of the recession are going to hit every company hard. It's just a matter of how much it's going to be hitting. So all the normal budgets are off, and we've asked all our portfolio companies to rebudget to the best of their knowledge on new budgets for this year and maybe even for 2021. That's the current status of the fund. So what about then existing versus new investments? A lot of people ask us all the time, so do you still do investments, or are you only taking care of your own portfolio? There's no doubt that I still have a requirement that I should bring back the money I have put into my fund 3 times back to my underlying investors. So I'm due to return the fund 3 times over a 10-year period, and unfortunately that requirement has not gone away. So I'm still under the same term, so to speak, with my investors, meaning that if I'm looking into a recession now, I have to be super careful that I keep investing in the best parts of my portfolio, and maybe divest what is not as performing as the best ones. So portfolio management is becoming very, very, very important right now, that we make sure that we keep funding the best parts of our portfolio. It also means that we have a focus on protecting what I would call my current assets. My current assets currently are the 24 companies that I'm already investing in, because I would probably be using more money on those that I was anticipating, because some of them are going to be running out of money sooner, because they're burning more money now, but they don't have revenues, they have a cost base that may be too high. So I'm going to be using quite a substantial more money, protecting just what I have versus new money being available for new investments. The third factor is visibility is very, very low at the current time. I mean, as I said at the start, we've been at home like 4 weeks now. We're probably going to be looking into a recession that could last at least a couple of years. So we're just scratching the surface of the effects that we see of a coming recession now. And that's one thing that we hate as investors, is investing in the blind. And currently we are in the blind. So that all pans out that we are very cautious on new deals. It's not that we're not looking at deal flow, and we get new pitch decks and and calls every day, a lot of them actually, because a lot of companies are in dire need of funding. But we're very cautious on new deals, but haven't stopped investing. Valuations on the left. Valuations are going to take a hit on this, which may not be bad, because I think they had maybe gone through the roof, at least in some areas. So maybe it's just natural that this cycle is becoming like a down cycle instead. And why is that? Because all the listed markets are down. If you have a stock portfolio yourself of listed companies, you've probably seen that it's down between 25, 35, maybe even 40%, depending on what companies you own. So all the listed markets are down, meaning that liquidity to do new investment is also down, because liquidity is in the listed market. It's not in the unlisted markets in which we operate. So again, if you are an institutional investor and you have, say, like 50-60% of your assets in listed markets, you have seen now that, you know, decline in value by 30, maybe even 40%, which also means if you have a balanced view of your portfolio, you need to take, you know, a similar amount of your unlisted assets, meaning again, company that flows into venture funds is going to be, you know, drying up soon. The prospects of recession is definitely going to be, you know, affecting valuations as well. In a recession, you know, customers are going to be shying away. They're spending less money. There's going to be fewer of them. So in a recession in general, you know, things are tightening up, and the growth path that you've been on, that was the thing that justified your current valuation, is just not going to be there, because you cannot sustain the growth that you had pre-recession in a recession. And if you're used to running, you know, at a growth rate of, say, like 15 month-over-month or even more, and you're going to be down to 5, you're simply not worth what you were pre-recession. So that has an impact definitely on the valuations as well. The other thing that you shouldn't be unaware of is that there's going to be some cynical people out there now. There's going to be a lot of companies that we're funding right now that have less runway or are running out of cash. And there's going to be investors that are going to be on the sidelines waiting for that to happen, to pick up those companies very cheaply. So again, if you are a startup, focus on your runway, preserve cash as long as you can, so we get into the recession, get more visibility, and maybe you can raise, you know, new rounds based on, you know, more visibility at least. In our situation, we are like an early stage fund. So again, I said pre-seed and seed mostly, meaning we have more development companies than operational companies, i.e. a lot of our companies do not have, you know, revenues still. And of course you can say then they don't have revenues to lose. And that's true. So some of them are less hit of, you know, lacking revenues from ongoing business. But then again, they're going to be entering a market, you know, at the time when they finish their product or services, where it's going to be super difficult to acquire customers. So I think we're equally hit on, you know, development companies and operational companies. And then lastly to the right, as I said, winter is definitely coming. We don't know the length and the depth of the recession. We know for certain it's going to be there. So prepare for that. And to any startup, we say these days, preserve cash at almost any cost. It also means that you have to cost cut. It means that you're probably not going to just be cost cutting, for what you like to cut. You need to cut mostly into your legs as well. And it's going to hurt, and you're going to lay off people that you did not want to lay off. But you have to get a runway that is at least 12 months out in time by preserving cash. And some companies can't do that because they were already fundraising, but you should almost at all costs, you know, preserve your cash. And another thing you should prepare yourselves for is that your revenues are going to be 50% off, maybe even more. So if the budgets are going to be redone, I would budget at least 50% less revenue and see how that puts you in place in terms of runway and the cost base that you can sustain in that situation. So that's kind of like the current view that we have here, you know. And again, I think we should open the session for questions now.
Definitely, and thank you a lot, Tommy, for giving us the overview of this topic. So you touched a little bit upon your own prioritization right now, focusing on portfolio and not that much on new investments. How do you see the time frame of that? Because I guess 17 investments is not enough in a fund like yours. But how do you see this time frame of this? Is that because of all this uncertainty right now, and you're waiting that out, or how do you see that?
So there's two things into play here. So every venture fund almost out there has a 10-year span. And in that 10-year span, the first 4 years are the active investment cycle. So I can only do new investments in the first 4 years of the fund. After that, I can only reinvest money into companies that I already have in my fund. And as I said at the beginning, I'm 2 years into my 4-year cycle now. So I have basically 2 years to do new investments into the fund. I haven't done 17, I've done 24, as I said. and we are due to do roughly 35 in total in the fund. So I still have, dry powder to do investments in the fund, and I need to do some. But it also ties into, as I said, that we are a pre-seed / seed fund. And as I move along in my 4-year period here, I'm going to do later and later investments, because if I do a pre-seed investment in year 4, I only have 6 years to bring that into a very, very profitable investment, which is a very short time. So if I was just starting the fund and it was like 10 years ahead of me, I could do a lot of pre-seed and seed investments. But as I'm moving toward, I'm in year 3 now, and soon I'll be in year 4, I'm going to be moving into late seed and maybe even early Series A territory, meaning that I, as a fund, I'm going to be moving away from doing pre-seed investment. I'm going to leave the early stage parts of the ecosystem, which could also be a problem, by the way, because if you see locally here in Copenhagen, you have other funds, say like pre-seed ventures and seed capital, that are fundraising right now, that should have new capital in to do early stage investment, pre-seed and seed, which they could be running into trouble even raising their funds right now from their institutional investments. And hence, we could see there's going to be a vacuum of very early stage capital here in our local ecosystem.
Makes a lot of sense. You mentioned a little bit about that you would see that, expect to see valuation drop, and also it's maybe moving from being a little bit of a founder market to becoming more an investor market, and some investors would maybe try to be a bit harsh on that. What would be a good advice for the startups, how to navigate in this if you are in a kind of a fundraising process? Is that accepting a lower valuation, trying to postpone your funding round, or what would be your good advice here?
So one of the advices that has preserve cash at all costs. There's no doubt fundraising in an environment where there's almost panic is never going to be a fun experience, because everyone out there is going to be preserving their own cash. Even the funds and the angels specifically are preserving their own cash. So if you need to fundraise now, try at all costs to not be, having to do that. At least buy yourself 3 to 6 to 9 months extra time by cutting your cost base now. So we as funds and as angels have left the panic mode and are more into like, okay, new situation, new modus operandi. We still need to deploy money, but we can do it in a controlled manner where we actually understand, what are the basics in the recession that we're in now. So if you direly need to raise funds now, you're in a bad situation, because valuations are taking quite a big hit right now because, again, of the panic, So no one is picking up assets at this time that they think is going to be cheaper tomorrow, right? But then again, looking at the valuations, the good thing about a recession is that we all get hit at the same time. So it's like buying a house. If you're in the market, and your new house, is dropping, well, your old house is also dropping. But as long as you're in the market per se, you really get hit alongside all the other guys. And if in general valuations go down, well, you don't get hit as much, because you go down with the market, but you also going to hopefully be on the trajectory to grow with the market again. And there is no way that this is not going to happen. The valuation is going to go down, because in a recession you cannot sustain the growth rates that was justifying your previous valuations. So they will go down, no doubt.
So if possible, postponing the funding round, focusing on the cost side, like making more runway for yourself is like an approach to it. Yeah.
And then, unless it's your very first funding round, there's no doubt that the best way to raise funds right now is going to your current investors. We look at new opportunities, of course we do, but as I said in my presentation, we first and foremost take care of what we have. That also means that we are going to be doing bridge rounds. We're going to do extra funding of companies for a short period of time until they can fundraise for real again. So I'm foreseeing that the next 9 months, rest of 2020, we're going to do a lot of emergency funding for those companies. We're going to do a lot of bridge rounds, that takes into consideration the new situation, but pushes a real round, an equity round, in front of the company. Again, to leave the panic mode and get into like a funding environment where people are actually making rational decisions and not panicky ones.
Makes a lot of sense, Tommy. How let's try to chip into some of the questions that we
Sure.
are so happy about already tipping in on the chat. So first one is from Richard. Richard is touching upon that a lot of industries and platforms will also see some opportunities here in this in this crisis. So
Sure.
how do you see this, and how do you guide your portfolio companies in also like approaching it as an opportunity?
That's true. And again, I think we've been operating for the last 2 or 3 years in an environment where you basically have, there's been ample money available to do anything. So corporations, funds, even startup had a lot of cash on their hand, meaning that, the cost of a given service was not that, important, to be honest. And people were making decisions based on they had ample cash on their hand. That is all changing now, changing for all the parties of the ecosystem, meaning that, cost consciousness, can I sign up for a service that is cheaper, better, better suited for my needs now and leave an expensive one? So all the startups that normally, disrupt, the fat cats, in their industries, they will have, a playful time right now because corporations are going to be cost cutting in a big time. And they're going to be looking for ways to reevaluate all the stuff that they have on their hands, all the things that they've signed up for, services, products, whatever it may be. They're going to be reevaluating that from a cost perspective, which they honestly have not been done so much for the last years now. So again, startups that are able to position themselves in that scenario will definitely have a good chance going forward.
Yeah, because it's also a little bit for you to really like find out about the teams you have invested in, how fast are they adapting to the change, and how are they using it as an opportunity instead of only focusing on the crisis situation, but also like
exactly. So we invested quite recently, like 3-4 months ago, just before Christmas, in a company that's in the hospitality sector. So a company that has partners that they rent out to business professionals and gig workers. And you would say, okay, this market has crashed completely. And it has, of course, short term it has, because no one's traveling, no one's moving around, no one's taking on any rooms or apartments. However, they had a very tough time even acquiring, real estate that they could use for their service. I can tell you now, there's a lot of real estate being made available because, and prices are falling on it. And again, because they're a very, very, very asset-light company, suddenly they have all the bargaining power in the world because real estate will also be falling, and prices are going to be falling. So they can take advantage of, again, that the fat cats, really have to shed assets and they have to dump their pricing. And they're doing that in a big way. So suddenly the world has changed within 3 to 4 months to the better for them. And I think as a company, you need to look at how do I pivot my business from what it was to something that can be, if not recession prone, then at least, more suited to operate in a recession environment. That's the pivot you need to look at right now.
Yeah, and then also an opportunity to like create even stronger companies to spin out of the crisis.
Exactly.
I guess in many ways.
Yeah.
Let's try to take another question. So a fast one from Andreas. So how do you still follow pre-seed investments 2 years into your investment cycle? So that's kind of like a yes or no. So do you still follow pre-seed or do pre-seed investments 2 years into your investment cycle? You touched a little bit upon that.
Yeah, so 2 years. 2 years definitely, and 3. Well, again, we're like 2 years and 3 months into our current cycle. We will probably do pre-seed investment for the next, until the summer break, and then we will probably leave that table again, because at that time we have something like 7.5 years to develop these companies to be really, really successful, which is a short time in my world. So at that time we will probably leave the pre-seed table and only do in seed and onwards.
Cool. Let's take another question from Nadim. What is your take on the potential growth in seed investments, and what was the case in the last recession? I read an article about, because some of the findings you can see from the last crisis, a lot of that came out of US, because that is where the venture market was most developed throughout the last crisis. But how do you see that? So a number and amount of investments.
Yeah. So first of all, there's no doubt there is definitely good investments to be made in any crisis as well. I mean, assets are getting cheaper. and we have to return the capital on our fund. So having access to assets that have become cheaper is by no means a bad thing. So that's the first thing. And then again, seed investments are inherently local. It's very rare that you see, foreign funds do extensive seed rounds in a given country. Most seed investments are done by, either local or regional players. So here in Denmark, for example, you would see mostly the seed rounds being done by either Danish or Nordic funds. Meaning again, you should focus as a startup your fundraising efforts on those funds, because we're still going to be investing. And I think that's another characteristic you need to bear in mind, that I cannot just sit on my hands for the next 2 years and just weather the storm and take care of my 24 investment. That won't happen. I still need to deploy funds, and I need to expand on my portfolio. So when the recession ends, hopefully in a couple of years or so, I can accelerate out of it with good companies on hand. So you're still going to be seeing seed investments being done, again, primarily by local funds or regional players, and you're going to be seeing them done at lower valuation. Yes, but that's going to be the entire market. So don't be so afraid of that. That's going to be justified anyway. The only problem I can see right now is that some of, again, as I said in the beginning, that some of the funds that do mostly seed investments are actually themselves fundraising right now. And if they don't close their new funds, there could be a gap locally here of those funds not having raised new capital for them to deploy in new investments. That's one of the problems I see right now.
And some of the findings out of the US from the last crisis were definitely that in the business angel and pre-seed levels, the amount of investments was the same, but the volume were lower.
Yeah.
And then in the seed A round and B round, there was a lower amount of investments and also a lower amount of volume towards it. So that was throughout what came out of it.
And I would agree, sir. And again, also say that one of the things we're going to be seeing, that companies are going to be much more frugal about their costs. They're going to be bootstrapping themselves to a larger extent. They're going to be able to operate on less cash. And again, in a liquidity, with all the liquidity that's been in the market for the last 2-3 years, and companies raising a lot of cash to just have it on hand. We see companies that have a lot of cash on hand, they're still going to be deploying it more cautiously, and companies that are lacking cash are going to be extending their runway again. So I think we're going to see smaller rounds also, because the company can operate on less cash, or they want to operate on less cash and to stretch again their runway.
Yeah. A question from Nils, and that's related to your LPs. So how will they do you think they will start to navigate in this? So although you have a 3x investment target as like an investment opportunity, do you see that your LPs actually transfer the committed money to your fund to make financial calls, giving their own losses right now on other activities? How is the terms there with your LPs?
Well, normally, committed capital is quite secure. I mean, again, so our LPs are the Danish Growth Fund and Dansk Vækstkapital. We have 6 family offices, and we have 3 foreign funds in the fund, all well capitalized, and not people that are just running out of money. We just did a drawdown, by the way, 2 weeks ago, and they've all paid. So it's not that they've run out of money yet, at least. And I also think, at least, some of the investors there you're seeing are, very heavy in the ecosystem. So the Danish Growth and Vækst Fund has every intention to make sure that there's still capital going to be available. And I foresee that they're going to be stepping in even more now to make sure that venture funds and angels don't fall on their back and stop investing completely, because the Danish Growth Fund is a public entity. It is in their interest, it's in the public's interest that they keep, pouring money out into the ecosystem. And they've already done a lot on loans, and venture debt, and all kinds of stuff, to aid, companies out there. So I don't foresee that we're going to be having trouble, getting committed capital out of our LPs. But then again, 2 years from now, I'm going to be raising, a new fund. So of course, I'm going to be judged by, okay, Tommy, how did you weather the recession? How did you invest? How did you keep investing? How is your portfolio doing? And can we trust new money to you and a fund 2 to invest in the environment that's going to be there in 2021, 2022. So I'm judged by the same criteria as a lot of startups are. I need to show that I can be, a wise man, hopefully during the recession, make good investments and still provide a return on my investments to my LPs. I think some of the LPs are going to be more focused on, venture funds that have more vintages, i.e. for more funds, and maybe even, that has more track to show. So first-time funds and first-time teams, as we were when we started, are probably going to have a harder time, operating in these times.
Then there's a kind of like the same question from Jeppe and Ardo about so how do you do these follow-up investments? Do you prefer doing them as a convertible note and postponing the valuation talk to later, and what would be your advice in this situation of doing these?
So it's very company specific. Most of the stuff that we're going to be doing now are probably going to be convertible notes, because at least in the current situation, no one has a clue what the company's worth. So we will probably do smaller ones, maybe just at the last rounds, valuation, or even a little less than that. But it's not going to be big rounds where we put a ticket on it. So yes, most of it is probably going to be that kind of instruments. We will still do, equity-based investments, but probably in like 6 to 9 months out in time, I would say. So yes, that's probably going to be it, Again, because visibility is low and we want to get out of this panicky mode where we don't really have any clue what the valuation should be. Where the convertible note, with some kind of cap that you can, agree upon, is going to be the best instrument, yes.
Yeah, so for both parts, it can be like the best solution actually postponing the valuation talks and giving a discount on a convertible note, because then it's like for both sides, maybe the most fair way of approaching it right now.
It is. Yeah. No one has the visibility. We don't, they don't. And we, again, as I said in the beginning, we want to be a founder-friendly fund. I'm not trying to screw my portfolio companies over. I'm not trying to screw over the deal flow either. Why should we? We're going to be in the market long-term. If we come out, as one that took advantage of the situations, we're going to be in a dire situation once this market, turns on us again, right? So we're definitely interested in making sure that we do, reasonable deals in this environment.
So just hanging a little bit onto that. So as a startup, what to accept and what not to accept raising funding these days. So we have this rule of thumb that don't give away more than 20% of your equity in a one round and all that. Do you think some of those rule of thumbs will change, or should startups stick to that and like?
I would say you should probably stick to that, because if you screwed up your cap table by giving away like 40% for a small amount of money, that's going to stick with you forever as a startup. So it could be that that it sounds attractive to do a deal like that, but then again the next deal is probably not going to be there. So you need to stick to a lot of the metrics that was still there. Maybe you should raise again. First of all, cut yourself down to being, a company that can operate on less cash. So even a funding round that you do today would last longer than it would a month ago, because you have more cost on your structure, right? So that's one thing. And maybe if that's the problem, I've seen some of our companies, going from rounds that were like this big and cut them down a bit, again, to make sure that they don't give away too much. That of course means they're going to be fundraising, sooner than they anticipated. And, that could be a problem, but, again, investing in a modus right now where no one knows what valuations are, and then probably going to be lowballing it, can be super dangerous for your cap table. So I would stick to the metric and the numbers that you usually would imply, and and try to weather that way around, because otherwise you're going to be screwing up your cap table and you will never raise money from any VCs again.
Good points. So now we've been circling a little bit about cutting down costs and also like raising funding and equity. And I guess the third leg to that is like the help packages and the debt providers now, and the government's chipping in to help companies get through the Corona crisis. What would be your take on that? Bringing debt into the company, bringing it through the crisis, and what is the good things about it and what is the bad things about it?
The bad thing about debt is it has to be repaid. So and you know all about that as a bank. I think the thing is right now, so again, if you look at our companies now, they still try to raise some kind of equity, because a lot of those guys, they don't have revenues that can actually, repay the debt. So currently, most lenders will not, provide debt of any significance to development companies that does not have an operation that, the debt provider can look at and see, are you going to be paying this debt back in 2 or 3 years' time? And if they do, they will look at us first and say, if we provide debt, you should also provide equity. So we at least know there's some equity to work with in the company also. So again, being a seed fund, most debt instruments are not really available, from banks and stuff, right? Then there's the help packages, and there's no doubt that you should make yourself, acquainted with, what's in them, how can they, provide you help. And you should use them, definitely. They are there to be used. And we have started now providing all of our portfolio companies an overview of this. So we try to be assisting in, how the individual company can make use of those packages. And as we have Nordic investments, or even in European investments, there are different, initiatives all over the Nordic countries. Deloitte has an excellent overview that they release every day, where you can see all the European, help packages being put in place, and they change by the day, and they still will change by the day. And we try to help our portfolio companies, apply and work with those help packages. And you should definitely use them. They're there for the same reason. And you can use them to stretch your runway. You can use them to steer away from extra equity at a low valuation. So definitely go use them.
Yeah, so it is a way of extending your runway and also like getting closer to maybe getting some more like certainty on the markets before raising funding.
And then of course also, one thing that you need to do, so in a recession like this, every agreement that you had in place a month ago is now up for renegotiation, be it with employees, be it with your landlord, be it with, service provider that you use in your company, and it's part of your cost base. The entire cost base is basically up for grabs, and because of we're all in the same situation, everyone is going to be at least open to discuss it, give you some leeway on payments, push out, rent payments, make your employees work like 80% of the time or 60% of the time, go down in salary as a team. All kinds of things are, in play right now. And, given that we have this crisis, feeling, all of us, we're all going to be open to do stuff that we would never even think of doing a month ago. And you should, of course, as a founder, be aware that that's the environment you're operating in, that you can do stuff now, and you can talk to people about something that you couldn't, even dream of doing a month ago. And you should do so.
Thank you, Tom. And I guess this is just could be like a follow-up on it. So getting debt into the companies, also inviting the banks and the growth funds into dialogues, and also in a part of like taking decisions for the company. And is that the right thing in the pre-seed level to invite banks and growth funds into like being a part of also decision making for the company, or is it like the equity space, keeping it on the equity level, making the financial side and the capital side of the company more simple? And then the question is, what would you agree that the company should try their best to limit the pledges of assignments that limit their negotiation opportunities in the future rounds, like having banks and growth funds on board could lag on the negotiation part for future rounds?
So this is often a question, is it bad or is it very bad, right? So if you don't have any equity options, but you do have a loan option, you should at least consider it. Of course you should. And so I think, what you should do now is making sure that you don't take decision that is going to hinder you doing, stuff going forward. So of course, if you take on a loan and the provisions of the loan are so harsh that you're kind of like tied in every way, before you repay the loan, that's not going to be a sound decision. You're probably going to be killing yourself before you get killed anyway. So of course you should be aware of the provisions that are there. But then I would say again, taking on loans, in conjunction with debt is not a bad thing. And we encourage that. We have done venture debt along with companies now, and we've done, loan packages along with equity. And we like, doing that. So we would happily support companies that are also able to service a loan, because again, extending the runway, giving them the freedom to operate for a longer term before they raise money again. So if you can, I would encourage that you do those two things in conjunction, because we can also negotiate with the banks and with the debt providers, making sure that the provisions that you get as a startup are not out of this world, because we've seen a lot of this stuff and we know a bad deal from a good deal. So I would encourage you, if you have current investors, to bring them into the discussion and not just do that negotiation on your own.
Good points, and I can just totally also support that part of it from the banking side. Two final questions, and we're also running out of time. So time flies fast when we have fun. But one fast question. So for companies, it's a question from Pierre here. What company is in a better position now for talks with investors? One that has runway and the long-term runway, or the ones that is like running out of runway? I think it's a rather concrete question, and yeah.
It is, yeah. And of course we see, pitch deck be put forward to us now that seems like, people are panicking, right? And, of course, so, but we don't look at it from a point of view of, are you running out of money? Because there are good companies that have just been caught in the midst of this crisis right now in their fundraising. For all the right reasons, they were fundraising right now, still good companies, and we will look at them not based on they're running out of money. We will not pressure them based on that. We can still look through, a current, cycle, and what the company is and what they're servicing and how are they recession prone. So it's not that we're trying to take advantage of that. Of course, it's better to have better runway, because then we can work in a more like controlled environment. We can work with them more longer term. If they're not running out of money in 3 months' time, it will look panicky if you have that kind of runway coming to us now. But it's not something that we use as a judging factor in itself. It's still the core of the company, the team, what they're doing, and how they intend to weather the recession and work through that. That's still the key criteria for us.
Good points. So the final question I would like to ask you, Tommy, is related to some of the really positive things we could see going on before the crisis, like focusing on the SDGs, having more like impact startups coming out. How do you see this situation affect into the more like impact related startups, where recession can enforce more like business focus, and these two can go hand in hand, but what is your approach to like impact investment and that space going forward and related to this crisis?
It's a great question, because so let's look at the political environment right now. So there's a lot of people saying, how do we open up society? Now we have to go back to work at some point, right? We have to open up, we have to go out and dine, we have to go out and spend money again. So what are we going to be spending our money on? And there's a lot of political debate right now. So the climate change, all the initiatives around that, and the green, the green focus on, establishing industries that work in that space is becoming even stronger now, saying that we should use this opportunity to reposition our industries around these areas. So I think there's going to be a political pressure to support and nurture those industries. So it could even be that those industries that were just like nice to have are going to have a much stronger political focus now. And we're not blind to that. We can see that if that's going to happen, if from a political, from a public sense, people are going to be stepping away from the kind of old school industries and really not pushing forward to support those industries that are more in that area. We're going to be following that, because if the money is there, if all the good entrepreneurs are there, we're going to be doing that. And even though we're in this strange environment now, though, the climate change challenges are not going away, and all the stuff that is surrounding those the SDGs are not going away. Maybe even more we can focus on doing stuff there. The only problem I have currently is that, as I said before, I'm 2.5 years into my fund cycle, so I have to step a bit away from the very, very early ones, and a lot of those companies are actually early stage, meaning that I will be more selective as to what I can do, but I will probably focus even more on the area as such. And I think you're going to see a lot of funds be doing that. So I'm not afraid of that. That's still going to happen, and maybe even accelerate it.
Really good point, and having impact is a huge opportunity, as you say, related to all the things coming out of the from the political side and all that. So there's actually really big opportunities to create greater business opportunities.
Yeah.
Thank you a lot,
Yeah.
Tommy, for joining in on this and for all your valuable insights. And as I can hear, is also that when things have settled a little bit, there will be money out there.
Oh yeah, it will.
When things have settled and things are a bit more clear, going like the future and that. But thank you a lot for attending, and I hope it was valuable for all you listening in on the call. It has been recorded, so we will post the recording on our homepage, where you also have the overview of all the webinars. And maybe you can share the homepage. So we have the homepage here. Hello. The first one is the homepage. That is where you can find all the recordings, and you also have like the upcoming webinars. The mail address here is for all of you who had some questions but didn't manage to ask them. You are welcome to send them in on this email address, and we will try to get back to all of you about the questions that you could have related to this topic. Next slide. Yes, this is the upcoming webinars. So we're already having the next webinar at 10 o'clock today, focusing on liquidity and how to work with your liquidity and liquidity budgets related to this crisis. Then we're having Dan coming in talking about the business angel environment next Monday. We are focusing on being a founder in these environments is super stressful. So how do you also take good care of yourself and what to be aware of? We're like zooming in on the SaaS business area. How is it being a SaaS business navigating in the crisis? And then the last webinar is about the currency changes that we have seen, also related to the things. So how to navigate if you have a lot of currencies that you are working with, and how to lower your risk on that part. So finally, thank you a lot, Tommy, for joining in here. It was super valuable, and have a nice day to all of you guys. The goal is for all of us to get the best possible out of this to the other side, where things are a bit more clear. So have a nice day, everybody, and thank you a lot for joining in, Tommy.
Cheers. Bye.
Cheers. Hi.